Hi, and welcome back to another lesson. So our next lesson is on stocks. Stocks are very important as you move on with your academic journey because this is another way of earning and investing your money that isn't taught in schools enough. So starting off, what are stocks? Stocks represent ownership in a company. When you buy stocks, also called shares or equity, you are purchasing a small part of that company. As a shareholder, you have a claim on the company's assets and earnings, and you can benefit from the company's growth and profitability. Stocks are typically bought and sold on stock exchanges, like the New York Stock Exchange, so NYSE, or NASDAQ. So this is basically saying that you can literally own a share in a company without actually being a co-founder or a big part in the company, and this is because you are buying a stock of it, that you invest money in it. Next up are types of stocks. Starting off, we've got common stocks. So here you have ownership and voting rights. So common shareholders have voting rights in the company, so voting on board members, etc. Next is dividends. They may receive dividends, which are a share of the company's profits. However, dividends are not guaranteed. Next up is potential for growth. Common stocks have the potential for price appreciation, meaning that the stock price could increase if the company does well. Next up, we have risk. In the case of company liquidation, common stockholders are paid last after debt holders and preferred shareholders. Next type of stocks we have is preferred stocks. So we have dividend priority. Preferred shareholders receive dividends before common shareholders, and these dividends are typically fixed. There's no voting rights. Preferred stockholders do not have voting rights in the company. There's less risk and less growth. They are less risky than common stocks because of their fixed dividends, but have less potential for significant price growth. So how do stocks make money? Number one, we've got capital gains. So here you can sell it for a higher price. If you buy a stock at a lower price and sell it at a higher price, you make a capital gain. For example, if you buy a stock for $50 and sell it for $70, your gain is $20 per share. Next up is dividends. So you have regular payouts, but these aren't guaranteed. So some companies pay regular dividends to shareholders as a way to distribute profits. For example, a company might pay $2 per share every quarter, which gives you a steady income stream. Next up, we'll be talking about how to buy and sell stocks. So the first option is a stockbroker. To buy or sell stocks, you'll need to go through a broker, which can be a traditional broker like Charles Schwab or Fidelity, or an online trading platform like Robinhood. Next up is market orders. When you place a market order, you are buying or selling the stock at the current market price. Third, you have limit orders. A limit order sets a specific price at which you want to buy or sell a stock. The transaction will only happen if the stock reaches that price. Next up, we'll dive deeper into risk and return. So when it comes to risk, the more the risk, the higher the return. So when it comes to risk, stocks can be volatile, meaning their prices can fluctuate significantly in the short term due to market conditions, company performance, or external factors like economic changes. Higher volatility can mean higher potential returns, but also comes with a higher risk. When it comes to return, while stocks can offer significant returns, the price of the stock can also go down, meaning investors can lose money. Long-term investors often weather short-term volatility in hopes of long-term growth. Lastly, we have stock market indicators. So first is the stock indexes. The S&P 500 and the Dow Jones Industrial Average are two of the most well-known stock indexes. These indexes track the performance of a group of stocks to give a snapshot of the overall market. Second, you have a term called bull versus bear market. A bull market is a period when stocks prices are rising, while a bear market refers to a period when stock prices are falling. So to wrap things up, investing in stocks can be a great way to build wealth over time, but it requires an understanding of the risks involved. By choosing the right stocks, investing with a long-term perspective, and staying informed about market trends, you can make educated decisions to grow your investments. Now, try the worksheets that go along with this, and see you next time.